There are some chart patterns through which momentum can be understood very easily, as seen here. This is a rising wedge chart pattern, and I am identifying a great swing here. This chart pattern explains a momentum very clearly, where bearish momentum is dominating as compared to bullish momentum. So let's understand how to identify this rising wedge, how to trade in it, and what sentiments lie behind it. But before we start, if you're new to this channel, please make sure to subscribe and hit the bell icon to stay updated with our upcoming content. So, as I mentioned, momentum can be identified through the rising wedge pattern. But before understanding momentum, it's important to understand the trend. Now, according to the Dow theory, there can be bullish and bearish trends. A higher high and a higher low formation signals a bullish trend, whereas a lower high and a lower low formation indicates a bearish trend. Along with this, we have momentum, where higher highs or higher lows indicate bullish momentum, or lower highs and lower lows indicate bearish momentum. Higher highs and higher lows, or lower highs and lower lows, can create a weak momentum, which often leads to a breakout or breakdown, signaling the start of a potential trend reversal. To understand Dow theory in a simpler manner, it's important to grasp momentum. When momentum weakens, the Dow theory becomes easier to comprehend. In sideways momentum, we often witness either a breakout or breakdown. That's why today we're going to discuss a bearish reversal chart pattern called the rising wedge. Just as we saw in the falling wedge, where the direction is downward, the rising wedge pattern typically forms in an upward direction. This chart pattern usually forms within 15 to 20 candles. If you observe here, the trend of the rising wedge is positive, and we can potentially see a reversal here. This reversal can generally lead to a swing. If you're using a time frame of 15 to 30 minutes, identifying such patterns can provide better selling opportunities. Let's explore how to trade using this pattern and how to identify this. Typically, a bullish trend precedes a rising wedge. The momentum of the bullish trend weakens, and during this period, higher highs and lower lows need to be measured carefully. The higher highs are relatively close, while the higher lows form at a distance. This pattern leads to the formation of a wedge, and at the breakout point, bearish momentum is reformed. Entry for selling occurs at the higher low trend line, and your stop loss will be slightly above the higher high. You could potentially expect a 1:5 or a 1:7 swing, depending on the time frame you're using. The shorter the time frame, the smaller the output, and the longer the time frame, the larger the output. Similar to how we understand the rising wedge, we can also understand the falling wedge. The key difference lies in the direction. If we observe this chart pattern, the lows being formed in the bottom side are either similar to each other or they are nearby. And if we look at the pattern, here we have lower highs being formed and the lower lows are being formed, after which we get to see a solid breakout. This is a falling wedge and this is a rising wedge. The interpretation of these patterns differs. One signals a bullish reversal, while the other indicates a bearish reversal. Generally, these chart patterns are used to identify potential swings. However, when identified on shorter time frames, your risk-reward ratio might be around 1:3 to 1:5. To learn more about the falling wedge, click on the link provided in the description and watch the video to gain important insights. I hope you have found all the essential information about the rising wedge. And for more videos like this, subscribe to Alice Blue's YouTube channel and turn on the bell icon to receive regular updates. Thank you.
Investments in securities markets are subject to market risks. Read all the related documents carefully before investing.